All right, glad to have you back. Well, International Monetary Fund's Managing Director, Kristalina Georgieva, has warned that the world is in danger and becoming mired with low growth, high debt paths that will leave governments with fewer resources to improve opportunities for their people and tackle climate change and other challenges. The result is increasingly dissatisfied population, Georgieva said during a press conference during the IMF and World Bank annual meetings in Washington. The meetings are clouded by a looming November 5th U.S. presidential election, which raised the specter that Americans are stung by high inflation during the Democratic President Joe Biden's administration, and he could return Republican candidate Donald Trump to the White House, ushering a new era of protectionist trade policies and trillions of dollars in new U.S. debt. Dissatisfaction is not unique to the U.S., Georgieva said, despite the global economy showing some resilience in the face of threats from wars, weak demands in China, and the lagged effect of tight monetary policy. Let's understand this fact. Nabila Mohammed is an investment analyst. She's with Chapel Hill, Denham. She joins me to continue this conversation. Nabila, good afternoon, and thank you for joining the program.
Good afternoon, Mr. Tolu. Thank you for having me.
Yes, it's good to start this conversation. My first conversation was around exports. I don't know if you listened a bit to that. But let's start ours with the revised global and domestic growth figures across the board from the IMF and World Bank. I am looking at it. There was a figure before. Now it's been revised considering what we see. How does that come to you? We'll do like an overview of what you saw in that report.
I mean, the World Economic Outlook report is a report that is published periodically every year. So it's expected that with every new issue, every new publication that they come up with, there will be some slight revision. And really, it is just to capture what has transpired between the last review and the current one. The last one was, of course, in July, and this recent one is this month. And we did see some revision, as you rightly said, with regards to growth expectations across different regions. But from a global standpoint, we see them retaining the 3.2% expected growth for the global economy for 2024 and 2025. However, when you drill down to the different regions, we did see some adjustments, and it's largely as a result of just an opportunity to capture some of the realities that are happening or peculiarities in those regions. If we are speaking to the Middle East, there is a lot of geopolitical tension and conflicts that is happening there. So there was a revision in that. There was a downward revision to their growth expectation. If we bring it down to our own region, which is Sub-Saharan Africa, we did see them bring it down as well to around 3.6% for 2024. And in 2025, there's an expectation that it will rebound to around 4%. So all these revisions were not surprising to us, given that there are a lot of peculiarities rather in these regions that have sort of developed or changed in the span of between July and the current month that we are in. So it is something that we sort of expected would have happened, because what they had started the year with in terms of outlook or in terms of projections, for some regions, for some countries, we've seen favorable downtrend in terms of inflation. I'm speaking to disinflation across certain regions and countries, but we've not seen that across board. So it's just warranted them to, revise the expectations with regards to growth and how it will pan out in the years to come. And we may still see some further revisions depending on how material there is a change in what is currently happening across the globe.
Brilliant start there. Now, let's stay with the fact that global economies are gradually addressing inflation, or should I say inflation is gradually returning one way or the other. There's a reduction in figures that we see. But our country is undergoing reforms at the moment. And these reforms, the World Bank and the IMF is saying, Nigerians, you must stay the course. This must not be like a policy instituted. And after some time, you're going back again and, bringing back years of challenges, of course, for our economy. What do you make of our country, considering what IMF has said and how it will fare moving forward?
So one thing we should always understand is that IMF's standpoint with regards to different issues or different economic indicators may differ, given that the country has its own peculiarities. There are peculiar things that Nigeria is facing as a country that may not necessarily apply to when we look at it from the IMF standpoint. However, they did mention certain things which I feel we can take from their report, which has to do with making sure there is that consolidation between policies that the fiscal authorities come up with and that acceptance or reception from the citizens that it would affect at the end of the day. So they did mention what they called the three policy pivots that revolves around the monetary policy, the fiscal policy, as well as the social aspect of it, where we bring in the citizens to really understand the importance of these reforms and how it will affect them going forward. So if we are going to indeed stay the course, we need that acceptance from the citizens to really understand the reforms that have been put in place and how it will potentially positively impact the entire economy, the Nigerian economy going forward. So these are the things that needs to be put in place, needs to be considered, and not just staying the course. We need that broad acceptance from the citizens with regards to reforms. And as I earlier mentioned, we have our own peculiarities. So our issues really are structural that need to be addressed before we can really see that acceptance from the citizens. I mean, you cannot tell a layman that they would have to just accept a price hike all of a sudden in terms of petroleum, and you are not giving them something to really fall back on in terms of cushioning the impact that would have on their businesses, on their lifestyle, on their livelihood, and how they just carry on with their lives going forward. So all these things are peculiar to us, and in as much as the IMF is seeing these reforms as positive for the country, we need to look inwards and really understand how the policy makers really have to look inward and understand how this would impact the citizens, and they should be willing to accept it. So it's beyond what the IMF says. It really just drills down or boils down to how it would affect us and how receptive we are to these reforms, and how they are putting in place things that would cushion the impact that whatever policies that would in the long term be beneficial to us would have in the short term on the citizens.
Still at the same IMF World Bank's meeting, the CBN reported an increase of external reserves. Many Nigerians have seen this as a welcome development. It sounds good. What does it mean for the Naira? Even as the IMF commends the Apex Bank on its policy measures at the moment, Mr. Cardoso was particularly commended, saying that he should stay with this policy. Now, that's one question. But why do you think that we're still hovering around 1,600, 1,700? Some still think that this disparity still remains so very much.
So to answer the first question, which is regards our reserves, we know that our reserves have improved, have increased, and it's largely debt-driven. You know, let's recall that there was the issuance, the domestic dollar bond issuance that we had earlier this year, and there is even the expectation that they are going to be issuing a diaspora bond from 2025 that will sort of be a monthly issuance that's next year. So all these are really what is elevating the levels of our reserves currently. Now, speaking to the currency, of course, the short-term way out to see any form of appreciation or stability will largely be this debt that we get and whatever funds that we get from maybe foreign portfolio investors. But we all agree that that is not sustainable in the long term. So we will still look to areas along the lines of improving export earnings, diversifying our export earnings as well, to make sure that we are not just dependent on oil exports and the receipts that we get from there, in order to see a sustainable or a more sustainable appreciation or stability in the currency. There was even a briefing they had with foreign investors, and there we really saw that there were questions around FX management and FX volatility. And what really the CBN explained was that they're trying to get to a stage where they will not have to intervene in the market for us to see some level of stability. So they are really just trying to make sure that the market is left to the forces of demand and supply for the rates to really be the actual rate of the actual value of the Naira to be determined by that. So we'll still see them intervene, of course, but they are just trying to work towards that. And I believe that is where the IMF is coming from when they mentioned that they like some of the policies that the CBN is doing around FX stability and just price stability, generally speaking.
Just like a follow-up, many will expect that this should drive more foreign direct investment, or the portfolio guys that we want to run in. I think they would like this environment that's talking about liberalization of the foreign exchange market. How do you see that?
So foreign portfolio investors are more or less driven by high interest rates.
Interest rates.
Foreign direct investments, on the other hand, will look more to structural reforms that are on ground that would, be more welcome into their business in terms of, we're looking at power supply, we're looking at good roads, we're looking at a number of other structural things that have to be in place. Insecurity too as well is very key for foreign direct investments to really come in. So I believe it depends on what form of investment we're looking at for. Regardless of the view we look at it, these issues along those lines have to be looked at and have to be considered before we see an improvement in that level. We're seeing foreign portfolio investments, go up. We're even seeing that remittances for the month of September alone came in at around 650 million. So that is encouraging in terms of the portfolio investment side. But in terms of direct investments, we're still expectant of the fact that structural things have to be in place for us to see more of those come back.
Geopolitical issues and, of course, the U.S. elections, wars, and all of that. We are seeing that this would also shape in some activities on the global front. And, that election, a much talked about election, everyone is looking at it. What if the table turns? What could happen? How do you see that also affecting the entire globe?
So, as you rightly said, geopolitical tensions are still there. In fact, it is one of the risks to the expected growth that the IMF forecasts for the entire global economy. And should it spiral out of control and go beyond the levels that we're seeing it will definitely negatively impact the global outlook in terms of growth and how it will trickle down to other regions or spread and disrupt production and supply chains. It would also lead to a negative impact in terms of commodity prices. And all this, you would agree with me, would just filter into a resurgence in terms of inflation. And that is what we've seen some advanced economies start to experience disinflation. So if anything just goes out of control with regards to geopolitical tensions, we'll definitely see that happen. In terms of the US elections, we are still, it's going to be in a couple of days, it is next month. It will largely be dependent on the policy directions of candidates that wins and how it will impact trade relations across regions, as well as just interregional trade really is where we will definitely see the impact, depending on the candidate that wins and the policy direction that candidate has for the entire US economy and how it trickles down to other regions, especially the sub-Saharan African region.
Let's now stay with Nigeria. What is your outlook for us? And you expected, what do you think will shape conversation at the next APC meeting? That's for November, obviously.
So for our outlook for Nigeria, we are broadly in line with the expectation of IMF. Our in-house expectation for 2024 in terms of growth is around 3.03%, which is just around 14 basis points shy of the expectation as put by IMF, which is at 2.9%. We still see that there is potential in the economy and other areas, other sectors that can really be developed and value can be pulled out of in order to see a much stronger number in terms of economic growth. Now, we still have high inflation, and our expectation with regards to the November meeting is largely that the monetary policy authorities will remain tight, will remain hawkish in their stance. However, it will really be dependent on how we see the October inflation print come out. So if you we are looking at expected, direction with regards to how they will do with the interest rate. We are in-house, we are looking between 25 to 50 basis points increase in the MPR because the stance is still hawkish.
Well, let's see how all of this plays out. Clearly, there's a lot of issues to look at, a lot in our plate for us to chew in this time. I must thank you so much, Nabila Mohammed, investment analyst, Chapel Hill, Denham. Thank you so much. Hope to see you again soon.
Thank you for having me.